Hello, everybody. This is Chuck Carnevale, co-founder of FastGraph's Fundamentals Analyzer software tool. And with today's video, I'm going to talk about a class of common stocks that I really haven't talked about much. And by the way, I wouldn't consider myself an expert, but it is something that it is a class of stocks that I think investors should be aware of. But more importantly, they should be aware of some of the unique characteristics that this particular class of equities has. And I'm specifically talking about REITs, which is, of course, an acronym for Real Estate Investment Trusts. And I recently had a subscriber request to talk about data center REITs. So I thought data center REITs would be a good place to start. I'll be covering other REITs, in different videos over time later on. But today I'm going to be covering data center REITs because, obviously with COVID and with the growth of the internet and data storage and, how many people were even working from home and all the Zoom meetings and, all the stuff going on, data is obviously becoming very powerful. So data storage REITs have been really hot lately. And so what I'm going to do here, I'm going to cover the 5 primary, and there's actually six primary data center REITs that I'll be covering. And I'm going to be recommending a couple here that I think are attractive. And I'm also going to be pointing out that there are some of these REITs that I think have gotten overvalued. Now I'm going to put these in order here. I'm going to put them in order of cash flow yield, and it's actually funds from operation yields. One thing about a REIT, a REIT is a special class of securities that was generated by the Act of 1960, where they're required to pay out 90% of their distributable income. And and they get passed through tax breaks, by the way, for doing that. But one of the things that's interesting about a REIT is you really can't value a REIT with earnings. You have to use this unique metric called funds from operations. And I'm going to show you some reasons why that's really true. So let me go ahead and get into REITs here with you for a while. Again, I'm not going to do a big talk. You can look up REITs. You can Google REITs. You can go to Nariet, the REIT website. There's plenty of resources out there for you to learn more about REITs. But let's start here by looking at these REITs. And I'm going to be looking at them in order of what I'm going to consider to be the least attractive, or those that have the lowest funds from operations yield to the highest. And this is just like the earnings yield. This is the inverse of the price to cash flow. It's the cash flow to the price, if you will. And it's telling you what your yield would be, based on receiving 100% of the company's funds from operations in the example of REITs. So let's start with the company Equinix. And I don't know a lot about these REITs other than their data storage. So I'm just going to be looking at what I'm seeing here on FastGraphs because there's some important characteristics I want to talk about. And I'm not real interested in talking about the specific merits of any of these individual data center REITs here. So I want to make that clear. But I do want you to see some things here that are interesting. If I look at Equinix here, first thing I want you to notice is they didn't start paying a dividend till 2015. So the reality of investing in REITs of all kinds, data center REITs included, is that they're typically yield investments. They're real allure because of their requirement to pay out 90% of their income. They're typically thought of as dividend yield investments. All right, now I've got a dividend overlay here that I haven't shown much in some of these videos, but it's a very important valuation overlay because what it does, it gives you the year-end dividend yield of the company, or in this case, the REIT, in contrast to its valuation. So when you're looking at the highest dividend yields, like here we have Equinix trading at offering a 2.59% dividend yield. You see that there in the third, column here of the pop-up. Today, that dividend yield is 1.79%. And that's what I mean by a valuation metric. In theory, you want to be investing in any investment, any dividend-paying investment, when the yield is high, because that's a mirror image, if you will, of the price. So here we see the price got very close to the company's funds from operations, or real close to a fair value 15 times funds from operations, which I consider a real fair value for the stock. The stock rallied dramatically. It's now trading at its normal price to cash flow, but that's a market multiple. And because of the hype and hysteria that's gone on, with the internet, as I mentioned in my opening remarks, these companies have really gone on a tear here of recently, and Equinix is certainly no exception. But I also want to make another point. We don't really ever use adjusted operating earnings like we do with regular C Corps or regular common stocks, and there's a reason for that. First of all, The reason probably is because there's really almost no correlation between a real estate investment trust stock price and its earnings per share. And that's because of a very unique characteristic of REITs. REITs raise capital, okay, and they're constantly raising capital. So if I look at Equinix here and I go all the way back, I'm going all the way back to 2000, this company had 2 million shares outstanding. These burgundy bars here are common shares outstanding. And I don't have that posted here, and I'll show it to you. So this is common shares outstanding. You can see they increased that to 3 million. That was a 21% increase. And then to 10 million, which was a 200% increase. And last year, they had 88 million shares outstanding. So the companies are very, very dilutive because they're constantly raising capital, because one of the things that a REIT has to do by law is invest in real estate or real estate-related products. So they're obviously needing a lot of capital to run their businesses. Now, having said that, and I mentioned earlier, these are all about income, let's go ahead and look at revenues. And I've got actually both metrics on this graph here. So you can see, even though they've issued a lot of shares, that's kind of been dwarfed by the enormous growth in revenues that these companies generate. And remember, now this is not net distributable income. This is total revenues in millions, net revenues in millions, I might add. But the point is, you can see that the REITs advantage, even though their share count is so dilutive and their earnings therefore are so spotty, and that's why you can't really measure a REIT based on its PE ratio. Because I also want to show you something else. If I go into like Google Finance here and I look at Equinix, if I get a quote on the stock, let me go ahead and get it for you. I want you to notice that the PE ratio is 147.12. Well, that's obviously a ridiculous PE ratio. But if I look at it, the company, from the standpoint of their price to FFO, even though I consider this company overvalued right now, it's the price to FFO is certainly a lot less than 147. What you're looking at here is a price to FFO currently of 25, which again is excessively high, I think too high for the stock. There's another metric that you use, which I'm going to move into the next stock and show you, that's actually some people consider a better metric. But the problem is we don't have as long a history as FFO, which has been the standard measurement for REITs for a long, long time. So let's go ahead and go to my next example. Let's look at CoreSite Realty Corporation. Now here, I want you to see that we have a blended FFO of 21.42, and the stock actually looks inexpensive here. But I get a lot of questions on using fast graphs, and I always talk about this being a tool to think with. When you're looking at these graphs, just don't take the picture for granted. Look at what's created the picture. For example, in 2010, we had a 322% increase. That drives this FFO growth to 27.96, we'll call it 28%. But then you can see that there's no number like that. And if I look at more recent years, the numbers even get lower. So if I shorten this to 10 years and get rid of that anomalous numbers, now I've got FFO growth of 13%, which is pretty realistic. And now I'm using a price to FFO of 15 as my fair value measurement. Back in 2014, the company was attractive at that rate. Now I want to go back through this dividend thing here also. I want you to notice again that when the valuations are lowest, that's when the dividend yields are highest. And, I'd want to be buying this stock, if I go all the way back here to when the stock was just a little bit, above overvalued. These are year-end numbers here that I'm showing you on the burgundy line. The dividend yield up here was 3.76%. Well, today the dividend yield is 4.3%, but we also can see the payout ratio of funds from operations has actually increased a little bit. But I don't want to get too technical here. The point I'm getting at is that, this got a 4% yield. It is very pricey. It's trading at even above its normal price to FFO. That's because, these data center REITs have been so popular lately. But I don't consider this a great investment now, because the future expectations for this company in the long run are for about 13% growth. But I don't think that justifies a 25 or 21 multiple. If I look at it from a standpoint of more near term, at least the next couple of years, the growth is only expected to be about 6.8% before it starts accelerating again. And that would tell me that this is actually an expensive data center real estate investment trust at this point. But again, it's a very good one and a very high quality company that has done, very, very well. But the next metric I want you to see is adjusted funds from operations. Now, adjusted funds from operations has some more, accounting convention in it, but for most companies, and CoreSite is one of the exceptions, haven't been reporting it. So normally I don't get the long history here, but I do want you to notice the earnings are a little lower. The AFFO, price to AFFO number is a little higher. That just tells me that CoreSite is kind of expensive, but it does offer a 4% dividend yield. It has traded at its current multiple historically. So if you were willing to say, okay, I'm willing to take that, risk of paying kind of a premium valuation to invest in this data center REIT, then you might want to consider it. This one has been nowhere near as dilutive as we saw with our first example. And then when I go ahead and look at the revenue line, which is critically important, you can see the company's generated significant revenues, but those revenues have actually dropped a little. Now, I do want to go and show you something else. If I look at revenues per share, I get a slightly different picture again, because again, I want to point out that the issue here is that REITs are all REITs. You'll find this to be a very common, no, I shouldn't say all, but certainly, because I don't know if that's true, the reason I say I shouldn't say it, but you're going to see very commonly in REITs where they'll be issuing common shares and raising capital on a constant basis because they need the capital to buy real estate, to generate the revenues, and ultimately the distributable income that, is the hallmark of investing in REITs. Now, I want to use this one as an example because this is a company, a REIT, that I actually invested in, and I consider it one of the best of all the REITs, and I know a little bit more about this. It's a great data storage REIT than I do some of the others, but I originally bought this stock at the end of August 2015. So I'm going to go ahead and pick my time right here. I paid about $64 a share for it. So this is close because I only have monthly closing prices on this graph. And then I sold it towards the end of March, and I sold it at just a little bit over $130 a share. This is close enough. So my rate of return was probably 20% plus if I actually had the actual perfect numbers on here. Now I want to make a point. I bought this company when its value was extremely attractive. If I look at it from this dividend yield column, I was investing in Digital Realty when its dividend yield was at one of the highest, levels that it had ever been in. I was buying it when the dividend yield was between 5% and 4.5%. I did not buy it here at its very peak, but you can see this would have been the absolute best time to invest in Digital Realty. And my point is, just like any stock, valuation makes a big difference. It's very important. Now, I sold this stock and it continued to rise for a few months after I sold it. Today, it's actually trading for less than I originally sold it at. And it, might be moving back into fair value. Obviously at this point, it's too early to tell. But the reality of it is that, I made a lot of money on this stock and I never, ever regret making a profit. And I felt that even though I didn't make a perfectly timed decision, I made a good decision. Now, once again, if I look at Digital Realty, we have this massive amount of dilution. But then when I compare that to revenues, the company's generated just a spectacular level of revenue growth, which I really, really like. And that's one of the things that attracts me to this, because ultimately the revenues are what's giving you the benefit of investing in REITs. Because remember, now it's called funds available for distribution. They call that FAD, or distributable income. You measure it on FFO. Now, I do want to show you AFFO, which there are many analysts that prefer AFFO, and it's actually slightly more conservative because it has some additional accounting adjustments. And you'll notice the AFFO numbers are slightly smaller because of that than the FFO numbers. But again, the point is that in this case, here's a classic example where they've only been reporting AFFO. Many REITs have only started reporting it over the last 6, 7, or 8 years or so, where FFO data, goes back a lot further. So I did want to make that point. Now, the next one I want to look at is a company called QTS Realty Trust. Don't know a lot about this REIT, but once again, I want to point out that I do have opportunities. Now, this is pretty close to the orange line. I would say this would be a great time to buy it. If I put my dividend yield, number up here, you can see the dividend yield at this time was about 3.34%. And then, the dividend yield at its low base here was somewhere, closer to 4.5%. These are really all about the income. And I do want to make that clear because they are primarily income vehicles. That's how they're built and that's how they're designed. But having said that, I'll just use this one as an example. Even though it's slightly overvalued, it generated significantly more income than the S&P, and it did generate slightly more profit. Now, keep in mind, as I showed in previous videos, the S&P 500 is also overvalued today at maybe even a higher rate than this one is. So even though both are overvalued, the fact that this REIT was pretty attractively valued back in the beginning here based on funds from operations. The reality of it is this turned out to be a pretty good little investment. And even though it generated all this extra income compared to the market, it actually outperformed it on a capital appreciation. So REITs can be very excellent investments. Now, QTS Realty has also been dilutive, but not to the extent that we saw with some of the other examples I showed. And again, if I look at their revenue growth has grown dramatically as a result of raising this capital and adding new properties to the mix. The next one I'm going to go to is CyrusOne, or symbol CONE. This one is actually pretty attractive today. It's not ideal. I like it when it's touching the orange line or below it. I would think this would be one of the REITs that you could actually, data storage REITs you could actually invest in today. If it stays within this corridor, it could give you some good returns. It's got more than a 3% yield. If I look at it historically, it has an excellent record of growing its dividend year after year, although that rate has slowed down a little bit. I want you to notice in the last few years, again, consider COVID here, for one reason. The company has produced significantly more dividend income than the market, and it's outperformed the market on a capital appreciation as well. And frankly, this stock is not significantly overvalued here. I don't remember if I showed this yet or not on this one, but it's also another REIT that's been very dilutive. Share count went from, we'll start right here at 21 million because they didn't have much in the way of dilution here. And then it's, over 118 million shares by the end of 2020. So, these stocks tend to be very, very dilutive. Now, just to use this as a point, if I go back and look at adjusted operating earnings, which is the metric I utilize for most common stocks, I want you to see the company doesn't have any earnings. And the fact that it's issuing that many shares has a lot to do with why you don't see any earnings here. You're measuring really a different share count, significantly different share count here than you were measuring here. But having said that, the distributable income, which comes from the fact that the companies, these REITs are able to generate such, staggering amounts of revenue, is where you really get the benefit and the value of a REIT. It's just a slightly different animal than your normal common stocks. And then finally, I'm going to show Iron Mountain here. Iron Mountain is kind of interesting. This is AFFO. Okay, this is the adjusted funds from operations. And again, you only have about 6 or 7 years of adjusted funds from operations. Funds from operations, as I illustrated before, they've been collecting that for a long time. And so I've got a much longer history of funds from operations with this company. All right. And again, you see this dividend yield column when the price gets really inexpensive, when it's really well below the orange line is where you're going to get the best dividend yields. Now, this one offers a 7% dividend yield. It's the highest yielding one. Growth is expected to be moderate, maybe 5, maybe 6 or 7%, but you can buy it attractively enough that counting your dividend and, just a little bit of growth mixed in here, this could be a very excellent long-term investment. Now, Iron Mountain is not a pure data center REIT, but it is a data center REIT, and it does have that as one of the properties or one of the areas that the company invests in. The stock was very inexpensive just a year ago. It's still now very, very attractive. And this, of all of these 6 REITs, would be my favorite. And interestingly enough, it's also about the least dilutive of all of the REITs that we've looked at here. And again, coming into the revenue line, it does have a very excellent record of growing its revenue. So, Iron Mountain would be my choice today. And by the way, I'm going to disclose that I'm long in Iron Mountain. I like all these other REITs that I've shown you here, these data storage REITs. I just think most of them, 4 or 5 out of the 6, are too pricey to be investing in today. But I'm not sure I'd be selling them, by the way, if I'd invested in them a few years ago when they were more attractive. Anyway, this has been Chuck Harville. I hope you enjoyed this video on REITs. From time to time, I'll be covering other categories of real estate investment trusts as well. But I really wanted to get across some of these nuances of REIT investing here. The dilution of shares, which leads to the massive growth in revenues to compensate for that. The idea that, you have to, they have a special, unique structure because of law. They're really all about distributing 90% of their capital and passing through the taxes. So, there are places in just about everybody's portfolio to include some REITs, especially if you can buy them at attractive valuation. And as Mr. Valuation, I covet that. Anyway, it's been Chuck Carnevale saying thanks for listening. I hope you enjoyed this video. I hope you learned a little bit about REITs. Like it if you did like it. If you didn't like it, give me a like anyway. Just be nice guys. Share it with your friends. Ring the bell. Do all that good stuff. I'll be talking to you again very soon. Thanks.